Picture yourself as the most unfortunate investor alive. Cash sits ready for the stock market, yet you hold off. The charts need to hit a record high first. Only then does your money enter the market. The dips pass by unnoticed. You buy peak after peak. You assume this person is ruined. They look like the ultimate example of buying high and selling low. Think about a different type of buyer. This woman waits for a drop. She refuses to put money in when prices look steep. She promises herself she will buy once the market corrects. A third person enters the picture. They keep waiting out of fear, refusing to invest a single cent. The ending is predictable. Inflation destroys their savings every year. Consider the first two people. Buying at record highs might hurt more than waiting for a drop. Waiting could cause more damage over the long run. We will look at the research and run the numbers to answer that question. Working through the math might resolve your anxiety about the perfect time to invest. Marduk Finance breaks down investing concepts using plain language. A quick disclaimer comes first. This is not financial advice, so let's get into the details. Two investors step into the picture. Investor A is Wendy, who waits for a dip. Wendy knows perfect timing is impossible, so she follows one rule. She never buys at a record high and waits for a 10% drop instead. Investor B is Bridget, who has terrible timing. Bridget invests whenever she has cash on hand. She refuses to wait and suffers from awful luck. Every year, she buys at the very top. Logic suggests Wendy should beat Bridget by a wide margin. Wendy avoids expensive markets while Bridget buys at the worst possible moments. The final numbers show a different outcome. Real research shifts the picture here. The raw numbers tell a very different story. Waiting for a dip sounds disciplined on the surface. It remains a strict form of market timing. You make a bet that prices will drop below today's level in the future. The market doesn't need to crash to ruin that bet. It only has to keep climbing right past your deadline. You get stuck right here. The real trap is underestimating the length of a prolonged bull run instead of predicting a crash. The data spells this out clearly. Archbridge Family Office tracked S&P 500 returns all the way back to 1990. The firm put three strategies under the microscope. Strategy 1, wait for a 10% drop from the peak before putting any money in. Strategy 2, buy the very second a new record hits. Strategy 3, pick random days to buy. Looking back, buying at record peaks produced higher average returns than waiting for a discount. The top also beat the random schedule. The result feels wrong. Buying at the top beats waiting for a correction. Record peaks cluster together. They show up during strong bull runs, periods of earnings growth, economic expansion, and heavy cash flows. A healthy market doesn't peak once and fold. It stacks multiple records back to back. Wendy sits in cash waiting for the perfect entry while the market climbs. That 10% drop never arrives. When it shows up, prices sit way above her original target price. Holding cash feels safe instead of risky. Waiting carries a hidden price tag. The real cost is missed opportunity. Wendy misses out on market gains. She loses compounding and skips reinvested dividends. Time slips away. Take Bridget, put her money in right before a steep drop, say the year 2000 or 2008, and that initial stake takes a brutal beating. The index plunges 40 or 50%. Watching the balance shrink hurts, but she keeps buying every year. Crashes happen, recoveries follow, new bull runs start. Those first purchases get decades to bounce back and multiply. Today's terrifying peak becomes a distant valley 10 or 20 years down the road. Picture planting a sapling in your backyard, the weather that afternoon barely registers. Sun or clouds, the seed goes in the dirt. The only thing that counts is putting it in the ground and leaving it alone for decades to stretch its roots. Then the mental game kicks in and trips you up. You look at the ticker and think the prices have climbed too far to be safe. That hesitation comes straight from loss aversion and regret aversion. A red portfolio stings more than a green one feels good. Record highs trigger loud panic alarms in your head, yet history shows a peak leads right into another peak. The index hangs around those top numbers most of the time. Sitting on cash waiting for a discount costs you the most important trading sessions of the year. Hartford Funds ran the numbers on decades of S&P 500 data to see what happens when you sit out the best sessions. Staying in the game crushed the returns of someone who skipped a few top performers. Missing the 10 best days across 2 decades cuts your total profit by more than half. Skip 20 days and that profit drops over 70%. The catch is when those big jumps happen. They cluster during the wildest market swings, right on the heels of a crash when everyone is terrified and selling. Waiting for the dust to settle guarantees you miss the bounce back. If you're finding this breakdown useful, take a second to subscribe to the Income Story. Now let's get back to the question that matters. What should you actually do with your own portfolio? You stay out of the market because picking the wrong entry point stings more than watching inflation eat your savings year after year. Which brings up the main question for your own portfolio. Do you throw money at the index without looking? A regular schedule beats perfection. You put a fixed amount of money into the market on that schedule. The market conditions change, but your routine stays the same. This approach works better than trying to time your entries. This is dollar cost averaging. You strip your feelings out of the transaction. You might feel ready to dump every dollar into a single S&P 500 index fund after looking at these numbers. Hold off for a second. The timing comparisons and the best days data all come from the US market. You have to ask if the US is the exception to the rule. Concentration risk is the main issue right now. T. Rowe Price tracks the MSCI All Country World Index. That index holds over 2,500 stocks. The S&P 500 holds about 500. You are looking at 5 times the number of companies. An S&P 500 fund doesn't give you 500 independent bets. Rockefeller Capital Management ran the numbers on this. Technology stocks make up about 41% of the S&P 500. You have to go back to the dot-com bubble to find a concentration level this high. Guinness Global Investors looked at the data from another angle. They compared the market cap weighted S&P 500 to an equal weighted version of those same 500 stocks. You see a small handful of mega cap names carrying the recent performance in the gap between the two. Those mega cap companies stumble and the whole index drops. The fall happens because of them. The S&P 500 remains a solid investment. You see excellent returns in the historical record. Over the long term, the S&P 500 outperformed the MSCI World. US companies drove that strength over the past few decades. Other indexes offer more diversification. If you liked today's video, please help us by subscribing to the channel. Hit the like button and tell us what we can cover in the next video.